Hi, should I be buying or renting a house? What is the most important money question that people have in their mind? You guessed it right. As per CNBC, buying a real estate is the top question that people have. We would examine this question under the current economic climate that we are in, led by high inflation, high interest rate, and volatile real estate prices, with focus on Canada. Some quick fact. As per Bank of Canada, home prices are up by 35% in just 4 years. Mortgage interest rates are up by 31% year over year, and rental prices have continually hitting record new highs with increases of about 26% in just last 3 years. As well, it is important to note that 2/3 of Canadians own home, whereas 1/3 Canadians rent home. Thus, this ratio is heavily skewed towards homeowners. Welcome to Money and Mind, your go-to channel for unraveling the mysteries of personal finance. I am Abhijit, your guide to navigate the world of money with ease and confidence. Buying a home is often an emotional decision. Since peace of mind is an important consideration that we have in our channel, we would like to focus this issue both from financial numbers perspective as well as do pros and cons, keeping peace of mind at its center. You may have heard or read the book called Tale of Two Cities by Charles Dickens. Real estate market in Canada that got played in last several years has been Tale of Two Canadas. On one hand, we have big cities such as Toronto and Vancouver, which has seen double-digit price increases, demand outstripping supply, as a result of which local government has to take a lot of action in the form of restricting entry of foreign buyers, restricting entry of students, stress tests for uninsured mortgage buyers by adding 2% to their cost of interest, and so on. On the other hand, there is rest of Canada where the real estate price growth has been much modest with no such demand-led pressure. So for our analysis, I have taken Toronto as the representative of the heated real estate market and Montreal as a representative of the much quieter real estate market. The decision of buying versus renting can be different depending on the real estate market fundamentals, as we'll see going forward. I have a template as attached for which I provided a link in the description that people can download and customize it depending on their individual situation. Let us understand some of the fundamentals of the market. I will start with Toronto. Cost of average home has been about $1 million without taking into account the condos or flats. Yes, you heard it right, it's $1 million. Property taxes are generally 0.6%, which is about $6,000 per annum in this case. I've taken 20% down payment to avoid the mortgage insurance cost. Canada Mortgage and Housing Corporation requires you to take mortgage loan insurance if your down payment is less than 20% threshold of the home value. Maintenance/replacement cost. As a thumb rule, one needs to set aside between 2% of the home value for such replacement, which would often be needed in periodic intervals. I am taking 1% in our case, so $10,000 for Toronto. National Association of Home Builders have come up with this schedule giving the useful life of the various components of the house. 20 years for roof, 15 years say for air conditioning unit, 15 to 18 years for furnace, and so on. Thus, it's important to set aside such money for those upkeep and maintenance when it will come up. The next item on the list is cost of home insurance, which is almost $1,400 on an average for a home of this size. Opportunity cost of capital. This is an important concept that we need to understand, which is pretty straightforward. It basically means the second most use of this capital if we would not have invested in real estate. Maybe we would have invested in our own business, buying fixed deposits, investing in mutual funds, stock market, any asset class, you name it. For simplicity, I am taking TSX or Toronto Stock Exchange rate of return that it has generated for last 25 years as the benchmark rate of return. It works out to be about 7. Incidentally, real estate of Toronto has also generated a 7% rate of return. In last 5 years, it has gone up by 43% or at an annual growth rate of 7.4%, which is almost in line with the 7% long-term growth. In this case, since our opportunity cost of capital is mirroring the long-term growth in real estate market, there is no impact of such investment from opportunity cost point of view. This brings us to EMI, which stands for equated monthly installments, or the cost of mortgage, which happens to be the single biggest cost or cash outflow when you are buying the home. I have taken a 6% interest, which is the prevailing fixed interest rate. One important note is there is a principal component included in EMI, which is not an expense but an investment. You can treat it as a forced savings as well. There is normally an amortization schedule that your bank would have shared when you start the mortgage, as per which the interest costs are higher at the initial phases of the mortgage and gradually comes down. Similarly, the principal cost is lower in the initial phases of the mortgage and gradually increases as the mortgage progresses and reaches towards its end. I have taken a loan tenure to be 30 years, which is the most common in the market. Since the principal keeps fluctuating over the tenure of the lease, for simplicity, I have taken an average of 180th monthly installment, which is almost the halfway for your 360 monthly installments for a 30-year loan. If you see EMI as a percentage of asset value, it is about 5.8%, whereas if you exclude the principal, your interest portion, which happens to be the actual expense, is about 3.4%. Let us look at the summary now. Total cost of ownership is about $51,000 per annum or $4,500 per month. However, from cash flow perspective, it is about $84,000 or $7,000 per month. Let us try to understand how much income you should have to qualify for this mortgage. As per CMHC guidelines, your housing costs, including your mortgage, property tax, etc., shouldn't exceed more than 32% of your gross income. If we apply that threshold, your gross income needs to be $234,000, which is really a very high income requirement even after considering that both the partners are working, which causes home ownership a real struggle in Toronto. Gross income for this purpose refers to your income before any deductions, including income tax. Now you know why home ownership in Toronto is such an expensive proposition. Now let's look at renting as an option. It costs about $4,000 per month for a similar house. Also, the rental insurance is about $450 per annum. Thus, in total, it costs about $48,450 per annum as a cost of rent. Conclusion: between renting versus owning, renting is much cheaper as well as involve significantly less cash outflows, whereas buying involves a forced savings / investment of about $2,000 per month in terms of the principal repayment, as we saw earlier. If we consider at what interest rate the cost of renting will be equal to the cost of owning, it works out to be 5.5%. You can do the maths in the template that I had shared earlier. Thus, owning becomes cheaper as the interest rates comes down and is lower than 5.5% threshold due to the appreciation in the real estate prices as we are seeing. Now let's move to Montreal. The cost of a new house in Montreal is about $520,000, which is significantly lower than Toronto. Again, we are trying to compare similar size houses. We assume the opportunity cost of capital at 7% as per earlier. However, the long-term growth of real estate prices in Montreal is about 5%, which makes it less lucrative than Toronto. One needs to consider the lost income, which is the difference between the opportunity cost of capital of 7% and the real estate growth rate of 5%, not only for your down payment, but also for your investment in home equity by way of principal payment for the mortgage. Let's look at the summary now. We have already discussed about the opportunity cost, which happens to be $2,300 for both these components of down payment and investment in home equity. Property taxes are about $3,900 per annum. Maintenance cost at the rate of 1% is about $5,200. Home insurance costs are about $900. Cost of mortgage, assuming 20% down payment, is about $30,000 per annum, which includes a principal payment of $12,000 per annum. Thus, the total cost of ownership is about $30,000 or $2,500 per month. However, from cash outflow perspective, it is about $42,000 per annum or $3,500 per month, which is almost half of Toronto. Applying similar CMHC guidelines of your housing cost not to exceed 32% of the gross income, your income needs to be $132,000 per annum, which is much more reasonable as compared to what we saw for Toronto. Now let's look at renting as an option. It costs about $2,500 per month for a similar house. Also, the rental insurance is about $450 per annum. In total, it costs about $30,450 per annum for renting in Montreal. Conclusion: between renting versus owning at Montreal, renting costs almost the same as that of owning, although it comes at a lesser cash outflow due to the forced savings/investment of about $1,000 per month. Thus, at an interest rate of 6%, which is the prevailing fixed rate, both the cost breaks even. Till now, we have evaluated this purely from financial perspective. If your opportunity cost of capital is higher than the real estate rate of return, it makes the case in favor of renting versus purchase and vice versa. Price to rent ratio. For a home buyer, there is a standard rule that means monthly rent must equal to 1% of the purchase price. In case of Toronto, it is just 0.4%, which is about 2.5 times lower than the benchmark, which makes renting lucrative. However, it is not so bad if you layer on the long-term appreciation that the real estate market is seeing. Short-term versus long-term. If you are a student or an expat who is there for a few years, it makes sense for renting not only from your personal goals since you have not decided yet to settle down, but also from financial perspective as you can't benefit from medium to long-term capital appreciation on the real estate. Let me tell you when is buying a real estate better from financial perspective. Number one, if the prevailing rent is more than 1% of the purchase price, that means the rental market is really heated. Number two, if your opportunity cost of capital is lower than the rate of return of the real estate market. Number three, prevailing interest rate is much lower than the rate of return of the real estate market. Number four, if you're thinking of a long-term investment, say more than 7 to 10 years. Similarly, let us see when is renting better. Number one, if you do not have the funds to pay the down payment, so buying is not an option, which is a no-brainer. Number two, if the prevailing rent is less than the percent of the purchase price. Number three, your opportunity cost of capital is higher than the rate of return of the real estate market. Number four, prevailing rate of interest is much higher than the rate of return of the real estate market. Number five, if you have a short-term horizon that is less than 7 years or so. If you are liking this content, can I ask you to smash a like and hit the bell icon to become a subscriber, as I will be posting similar interesting videos. Now let us examine this issue qualitatively from pros and cons. Number one, amenities versus customization. Many rental properties offer access to amenities both on-site or nearby, such as swimming pool, party room, etc., which you miss when you move to your own house. On the other hand, if you own your own house, you can customize it based on your own requirements, whereas you're always dependent on landlord's permission to make any significant changes when you are renting. Number two, flexibility versus stability. Renting provides flexibility, say for someone who is moving in his career, whereas owning provides stability. So one needs to ask if they are able to see themselves in the same place for at least 7 years or so before making any buying decision, particularly if the market is volatile. Number three, personalized aesthetics versus less work. Renting often is less work as the owner is supposed to take care of any major repair, maintenance, and making sure that the house is fit to live in. but it limits your freedom in terms of changes that you would like to make, say in your kitchen or washroom, and have to make peace with what you have. Number 4, emotional satisfaction versus less worry. Homeowning always provides additional peace of mind as you can reverse mortgage your house to make a living during your retirement life, whereas renting often comes with less worry as you need not worry about the upkeep, change of mortgage terms, interest rate, and so on. Thanks for watching this video. As always, please remember, less is more and do more with less. Adieu until we meet again.